There are lots of great dividend stocks in Canadian market. So picking 10 great stocks from different sectors is not a difficult task. In this video, I will pick two must-have stocks in any dividend portfolio. One I already have in my portfolio, the other is in my watch list and soon will be added into my portfolio. So stay tuned. Small-time investor who mainly invest in high-quality Canadian dividend stocks. The aim of my investing is not to become a millionaire overnight, but to invest small amount of money that you can save from your day-to-day life without making much sacrifice. And then to build a high-quality diversified portfolio so that the money can generate a passive income. The motto is make your money do the work. I'm not a financial advisor, and the aim of this channel is not to provide any financial advice but to document my journey on Simple portfolio from $0 to hopefully $100,000. So, in this channel, I will go through my portfolios, my monthly dividends, analysis on why I buy a specific stock, and any other major update that is happening in Canadian markets. Please go through my videos, and if you find it interesting, please subscribe. I will appreciate all your support. The first stock is from energy sector, to be specific from oil and gas midstream industry. This is the first Canadian stock that I have owned and I love this stock. It is Enbridge. Enbridge Inc. is a multinational pipeline company headquartered in Calgary, Alberta. It focuses on the transportation of crude oil and natural gas, primarily in North America. They have a market cap of 79.7 billion and also have a workforce of more than 12,000 people. Enbridge transports 25% of all crude oil produced in North America, where they have access to more than 75% of refineries. They transport more than 67% of Canadian crude exports. Enbridge supplies 20% of natural gas consumed in US, also serves more than 150 LDC customers including Fortis, CFE, Nextera, Duke Energy, and so on. Enbridge is also North America's premier gas utility franchise, servicing 75% of Ontario's 14 million people. Under the renewable sector, they have wind farms, solar facilities, geothermal and hydro facilities in Europe and North America. Enbridge is targeting the debt levels between 4.5 to 5 times debt to EBITDA, which, given the low risk model they operate, maps strongly to BBB plus credit frameworks across all of Enbridge agencies. During the Q1 results, it was announced that Enbridge intends to grow dividends up to the level of DCF per share growth, which is projected to be 5% to 7% through 2023. Investors will be hoping for strength from Enbridge as it approaches its next earnings release, which is expected to be July 30, 2021. On that day, Enbridge is projected to report earnings of $0.47 per share, which would represent year-over-year growth of 14.63%. Compare the shares returns for the past 25 years, Enbridge has a maximum return compared to its peers. Enbridge common shares have a 10% compound annual dividend growth rate over 26-year period. Enbridge remains a top of mind choice in 2021 because of its generous dividend payout. At $49.34 per share, with an amazing year-to-date growth, the dividend yield is 6.76%. That makes them one of the best stable dividend payer in the market. Market analysts maintain a strong buy rating too and forecast a potential upside of 49% to $60 in the next 12 months. Enbridge has paid dividends for over 66 years to its shareholders. Currently, the dividend is $3.34 per year. The dividend increased from $0.81 in Q4 2020 to $0.835 in Q1 2021. The target dividend payout ratio is between 60 to 70% of DCF, providing a healthy balance between returning income to shareholders and retaining income for reinvestment in new growth opportunities. The price of Enbridge was high during the 2014 to 2017 period. That is the time when oil and gas was booming. Around October 2017, the price dropped below $50, and during the mid of 2018, it dropped to low of 38. After that, there were some ups and downs and was really picking up when the COVID outbreak happened. It took a while for the stock to pick up after the COVID dip. It even went further down at the beginning of November 2020. The last 6 months and 3 months shows an upward trend, and the current price at $49, showing a downward trend in the last week. So it is sitting currently at the top half of the chart for the year to date. So let's see what analyst and rating has to say. It has a smart score of 10, which is the maximum and means that all the statistics shows an outperform score. The analyst has a strong buy option with the average price of 57.21, which is almost a 15% increase from the current price. Stock bloggers have a bullish sentiment as well, a 95% for Enbridge, which is much higher than the sector level of 70%. The hedge fund activities has increased. However, there has been selling of shares by the corporate insiders, the only negative score in the dashboard. Tip rank investors had a positive sentiment for the last 30 days, dropping that bit in the last week. The news on Enbridge is also bullish. Even the technicals and fundamentals of the stock is very positive. Enbridge is definitely a must-have stock in any long-term dividend investor's portfolio. The question is what price you have to enter. For me, the price range of 43 to 45 would be great entry point, and definitely this is a stock that you can keep on buying during the dips. The next stock is from the utility sector, Fortis. Fortis Inc. is a St. John's, Newfoundland and Labrador based international diversified electric utility holding company. It operates in Canada, United States, Central America and the Caribbean. They own multiple regulated utility companies. Fortis BC, Fortis Alberta, Maritime Electric, ITC, Caribbean Utilities are some of them. 93% of Fortis total assets are investments in infrastructure that support the safe and reliable transmission and distribution of electricity and natural gas to customers. Fortis has a long track record of delivering strong growth through acquisitions and organic projects. With these acquisitions, they have now 10 strong utility operations around the globe with an asset of over 56 billion. Fortis have a market cap of 26.4 billion with 469 million outstanding shares. Fortis is also very reliable and strong dividend yield company with 47 years of consecutive dividend increases. Along the acquisitions, Fortis internal projects are also part of the growth story. Fortis is working through 19.6 billion 5-year capital program. The company will invest 3.8 billion this year. Fortis expect the organic developments to boost the rate base from 30.5 billion in 2020 to 36.4 billion by 2023 and 40.3 billion in 2025. Fortis completed its Oso Grande wind project in May and is making a good progress on other initiatives. In total, beyond the current portfolio, Fortis is evaluating opportunities across its electric transmission grid in the United States and looking at liquefied natural gas infrastructure in British Columbia. Fortis recently entered an agreement with the Canada Infrastructure Bank to fund 40% of the 1.7 billion Lake Erie Connector Electric Transmission Project. All the permits are in place and Fortis is working on concluding the transmission service agreements. Fortis is one of the Canada's top dividend growth stocks with a yield of 3.59%. The company continues to expand its operations and provides investors with great guidance on dividend increases. Fortis has increased its dividend in each of the past 47 years. That's a great track record for an income investor. In 2020, Fortis has paid a dividend of $1.9375 per share. In 2021, for quarter 1 and quarter 2, the dividend was $0.505 per share, which means if it pays the same amount for the next 2 quarters, the annual dividend for 2021 would be $2.02. Fortis gets the majority of its revenue from regulated assets. This means cash flow is predictable and reliable. Looking at the 5-year chart, overall it is a growth pattern around 22% increase in 5 years. There was a period from November 2017 to October 2018 where the stocks was underperforming. However, after that it steadily went up from $41.54 to $58.48, and then the COVID happened. If we look at the post-COVID, it was kind of up and down. Even now, it has not yet reached the heights that we seen before March 2020. It seemed like there was a quick recovery, immediately shot up to $55.41, but then it took more than a year again to reach the same numbers. The 1-month chart shows a mirror image graph, downward trend for the first half and then an upward trend. The recent chart is also on a positive note. The ratings of Fortis is at a neutral level. Mostly the analyst's rating is to hold the stock rather than adding more. The price target has been achieved. But in the blogger world, there is a 100% bullish sentiment which is way above the sector bullish. Hedge fund activities has been decreased, whereas the insider activity shows that more shares has been bought by the corporate investors. Tip rank investors have a negative sentiment. There is not much happening in the news and hence it stays at neutral. The fundamentals of the stock are really good. Simple moving average is in positive. We have seen that stock has been doing good for the past 15 days. But the ROE is at way below of the ideal 10 to 15%. My take is that Fortis stock deserves to be a core holding for a buy and hold dividend portfolios. I have not yet invested in Fortis. It's been in my watch list for a while. I'm looking for a correct price to enter. So those are the 2 stocks that I believe should be in every passive income investor's portfolio. I hope you like this video. Please let me know your thoughts in the comments below. I will be back with another video soon. Till then, stay safe.